So controversial to what the media may be saying, I'm going to tell you today why interest rates absolutely do not matter. And no, this is not a sales ploy to get you to buy any time of the year. This is for a mindset shift to get a bigger perspective about what rates are doing and why they matter. But more importantly, it's going to come down to what you can afford. So yes, it's going to affect your affordability slightly, but there's ways we can negotiate that and get you a better rate and a better monthly mortgage amount if we just play things strategically. So let's dive into the video all about interest and how that does not matter. So the reason I'm going to talk about this today in the video is because I just had this conversation with an agent last night. She has a buyer that wants to submit an offer on one of my listings. And we were talking about rate buy downs and seller credits. And that's something you're going to hear a lot right now in the real estate market because it's a little bit slower. And so sellers are not desperate, but they definitely want to drum up as much interest as they can. And one way they can do that is by offering seller credits to the buyer, which just means the buyer is going to make an offer on a home, right? And then the seller is able to give them a little bit of their money back to go towards their interest to help pay down their closing costs. There's a couple other ways to use and leverage the credits, but if you're not familiar and you don't work with a lender who's just knows what they're doing, right? It's easy to find misconceptions or just false things about the buy downs. And every company is going to be different too, obviously. But when we're having this conversation with the agent last night, she said she's only heard of a 2-1 buy down and like a 3-2-1 buy down and stuff like that. She hasn't heard of a permanent buy down. And so her objection to the buy down was that she knew after 2 years or 3 years that her buyer's interest was going to go back up and their monthly payment was going to increase. And she said she wasn't interested in that. So I said, actually, we are able to do permanent buy downs, which means their monthly mortgage is fixed for the life of the loan, so the entire 30 years, and their monthly payment's not going to change at all the whole time that they're owning that home, and we're still able to buy down their interest rate significantly. So good to know, and this is just education piece, not only for realtors, but also for buyers and sellers to understand the market and how we're kind of moving pieces around to make this perfect puzzle so that the offer makes sense for the seller, and also it's a win and a good deal for the buyer. So I'm going to break down the different types of buy downs and what that kind of looks like. And I'm going to trust my editors to make this real good for you so you can see it visually with some text and stuff, because I'm just going to read through my lender's text message. Shout out to Brian Hirono. He's amazing. We do a lot of this on our clients, and he does a great job of educating. And so typically we'll sit down, we'll have a Zoom call. He has a program that we can see column by column comparisons on the different months and the different buy down options. So what he says, permanent buy down, which is what we do all the time, is as it's worded, which is permanent. So the interest is bought down for the life of the loan. So the big benefit here is that the discount points are a percentage of the loan amount needed to buy down the rate from par. And you're going to hear this term par a lot, okay? So he says, think of rates as an elevator shaft where you're not locking into one single rate, but a whole column of rates, right? Like par is the ground level, okay? So he said, go to the penthouse, which means higher in rate. You're going up the elevator, right? You can apply this credit to cover your closing costs, okay? So again, just think of it as a puzzle piece. We're moving things around to make numbers make sense. And then he said, going down to the basement, okay, so we're going below par. We're going all the way down the elevator, is paying discount points. And you have to pay a one-time fee to buy down the rate, or better said, someone has to pay the fee, right? So we're not saying the buyer has to pay the fee. The seller doesn't have to necessarily, but someone does. So we're going to work this out. It can be the buyer, it can be the seller, or it can be the agents to help pay for this down. When the buyer pays out of pocket, the limited points one can buy down is 1 to 3%. So just keep that amount. And it depends on the loan amount because of closing costs and before high cost lending laws come into play. So we're not trying to get into any red tape. We're trying to stay really legal and really safe here. We're not trying to bend the rules, okay? He says when the seller or agent, otherwise known as the interested parties, pay for it, the buyer can buy down 3, 6, or 9 points if it is structured correctly. And he put this in all bold and all caps, so let's make that clear. Correctly. You need someone who knows what they're doing. This isn't going to be the lender's first time structuring this. Go to someone who's experienced in moving this stuff around. So the points and the percentage can be changed interchangeably. Okay, so multiple moving parts again. We're going up and down in the elevator. We're trying to find a happy middle. So the benefit of the buy down is that it's for the life of the loan and there's no expected or scheduled changes in monthly payment again. Typically, the discount points paid upfront is a tax write-off, even though it was covered with seller credit. And that just really depends on how the lender and how they issue the 1098. But the buyer can qualify with the bought down rate, which generates affordability, right? So if we're talking about pre-approval amounts, and let's say your max is $600,000, if we're factoring in seller credits, then that's gonna bring down your interest rate, which then boosts your affordability. You see how this is working? So we've got like all these different balance points that we're weighing out. And that can actually help you afford more knowing we're gonna buy down the rate. If the interest rate is at a 7% today, that means we can buy it down to 6.5 or 6% using those seller credits, which then boosts your affordability like accountantly, right? Okay, so he goes on to say, the con of this is that the monthly payment may not be as low as a 3-2-1 or a 2-1 buy down. So it's not tried as attractive, or it's not like a sexy buy down, right? Because ideally, I think what a lot of people are pushing right now is the 3-2-1 or the 2-1 buy down, which just means you're buying down the interest rate for a period of time. But then after that time expires, your interest goes back up to whatever the market rate is. So let's say fast forward, you bought it down for 2 years. So in 2025, you go back to market rate. Well, what if, and this is very possible that this could happen, what if in 2025, the rates are at 10%? Like, let's not forget that at some point they were at 15 and 20% in the 80s, okay? So rates always fluctuate. They go up and down like the stock market, and we're not trying to time the market here. We're trying to find an affordability that makes sense on your monthly payment, but we don't want any surprises if you're doing the 3-2-1 and the 2-1 buy down. And it's not always a guarantee that you can refi and get money back. Like, let's say hypothetically, worst case scenario, in 2 years, the market actually goes down more. Let's say it goes up again for 2024 and then comes down again. What if your home value is worth less than what you bought it at and you're trying to refi? That's just not gonna work. So we're always thinking 3 steps ahead. We're always being conservative, making sure you feel really comfortable about this. The goal is though that you would refinance when the rates dip if you did that. So we're just kind of timing the refi, but that's the lender's job to hold you accountable and make sure that you're in the know when the rates dip. But to sum it up, he says, while it might be attractive to get a temporary buy down, always remember that it's temporary, right? So we just said this. If you're just barely qualifying and you cannot anticipate an increase in income in the next few years, like let's say you're in a medical residency now, but in 2 years, you're gonna become an anesthesiologist, making $300,000 a year, a temporary buy down would make a lot of sense. However, if you're a self-employed entrepreneur and your income is not consistent, right? Maybe this is not a good plan. This puts us in the risk zone. Another advanced scenario, he said, is when a temporary buy down might make sense is if the buyer wants to put 5 to 10% down. And I feel like a lot of clients who are using the buy down strategy don't have a lot of cash, so that doesn't make sense. But if you do have 5 to 10% down and you can plan to aggressively pay down the principal during those first 2 to 3 years, then your payments are gonna be way lower and you can actually recast your mortgage monthly amount. The bank can redo an appraisal and recast how much you actually owe back and lower your monthly payment. So he's a wealth of knowledge, and obviously I'm not a lender and I'm not even claiming that this is gonna work for everybody, right? Everyone's situation is so unique and so one of a kind that we just have to sit down with a professional lender who knows these buy downs like the back of their hand and can advise you on your situation and what's best for you and the family. This is what we do every day. And I just wanna tell you guys, like, there's so much encouragement thinking about long-term planning, right? We're not buying into a house planning to sell it next year. That's just not gonna work. If you're one of my clients, I say you cannot tell me in 2 years you wanna sell your house because we might be upside down. I wanna make sure you're in the positive. The market continues to fluctuate, but what's really special about Hawaii is on average, every 10 to 12 years, our market doubles. And so when you think about that, yes, it's going up, it's going down, it's going up, it's going down, but on average, we're going up about a rate of 5 to 7% in appreciation, which just means just by you paying the same exact monthly mortgage every single month, your home is growing in value. So what happens in 3, 4, or 5 years, well, guess what? You've been paying the same payment, but now your house is worth a lot more. And you've also been paying down the principal payment on your loan a lot more. And that's where you have the equity gain. And really that's the leverage, right? That's the power of home ownership. I just posted in my Instagram stories today, I said, would you rather make $50,000 passively for the next 3 years? Let's just say you just woke up 3 years later, you didn't do anything different, and you got a check for $50,000. Would you rather have that scenario? Or would you rather pay $192,000 and lose that money? Because that is literally the difference between renting for $3,000 a month for 3 years versus buying a condo at $500,000 and just paying the same payment every month for those 3 years. You can either have a fat check or you can walk away with nothing. This is the big preface. I just want to shake people up a little bit because we're so sensitive to rates right now. And the reality is it doesn't matter what the rate is because there's always going to be a way to negotiate that and to work out a number that works for you guys. So don't let the news, don't let the media tell you otherwise. It comes down to what's best for you and your family. Really, it's like we're looking for a good credit score over 620, a little bit of cash savings, ideally 10,000, but you can have less, like with a VA loan. If you've only got 5,000 to put into this, we can work with that. And we really do on the VA loan, we can get everything covered for you. So you're zero money out of pocket upon closing. Like I said, there's so many different options. And even for first-time buyers, if you're looking at an FHA loan. There's so many different ways to leverage things, but the more cash you have, obviously it's gonna position you a little bit stronger, just give us a little bit more leverage, but don't let not having cash be the reason for stopping you, okay? The main thing is solid income, consistent income. Our debt, like our monthly payments, are not more than half of what we're bringing in, and we have the amount that we need to pay the mortgage. So we're just looking for that monthly comfortable amount that feels good. We're not gonna be house poor, but it's something that's conservative and really makes sense for you and your family. So that's that. This is the end of the video. I know that was a lot of really nerdy information and numbers and stuff, so I would be happy to sit down with you guys, break it down. When you see it visually, it really does help, and you'll see like the different columns comparing each scenario and how that monthly payment kind of changes with each one. So we've got tons of options. Next video is coming up next Friday, and we will see you guys soon. Thank you.